All right, so I've been looking for some other energy companies to look into, maybe dip my toes in the water a little bit around them. There's a lot of very good strictly oil and gas companies. I mean, there's an endless list of them. But I wanted to talk about maybe some exposure to some other stuff as well. And I came across this one that I really like. It's Alliance Resource Partners. Again, $2.5 billion company. They pay a very high dividend at the moment, just under 10%. Their earnings yield is 17.46, which is very high. So they literally almost could be paying double the dividend that they're currently paying. They kind of have two different things that they're a coal producer and they also have oil and gas royalties. So they are pretty diversified, right? And not only that, they're even diversified in the coal sector, right? And again, a lot of people hear coal and they think it's some dirty word, but what people don't seem to realize is coal is used a lot in the manufacturing of steel, which is something we're going to need quite a bit of because again, if we have a rapidly growing population in the West, well, more and more buildings need to be built, right? And not only that, a lot of buildings are old and they need to be redone and, et cetera, et cetera. Like, look at how much some of these cities are growing too. So I think that this is an industry that has a lot of tailwinds. Obviously, again, my opinion, do your own due diligence and whatnot. Analysts are very bullish, although I don't think there's too many analysts that are covering this stock, but still very bullish. And again, even if this company goes nowhere, right, you still have a very nice dividend, right? I mean, and let's look at that dividend again. Again, payout ratio on free cash flow is only 62%, so it's in no harm, or sorry, no, very unlikely this dividend is going to get cut, right? And they are growing it ever since early 2020. So that's a very good sign, right? I mean, it's gotten as high as $2.70 a share in 2015. It's currently at $2, right? So I think that it's probably gonna be high. Where it goes in the next short period of time, I don't know, but I think 5-10 years from now, this is a company that you could have, a 15 or a 20% yield on cost, like easy in 5 years, right? 10 years, right? So that's one of the main reasons why I'm interested in this company. The other one being, again, they're fairly profitable too. I mean, if you look at their gross margins, like over 90% every year over the last 10 years. Free cash flow margin, a little, not super inconsistent, but I mean, 19% last year, 21% the year before that, 10, 23, 23, 31. So a little inconsistent. Operating cash flows is very good. Return on equity, again, 2020 was a bad year, but that was a bad year for obvious reasons. But other than that, it's pretty strong. ROIC, again, fairly strong as well. Operating cash flow per share definitely has gone down, but that's for obvious reasons. It still is fairly strong. And current ratio, again, has a solid balance sheet, just under 2. If we go into the actual cash flow statement here, which is something that I really like to look at, again, the last 2 years they've been paying down debt, which is something you really want to see if you're looking at any company, but any company you consider to be a good company. They haven't issued a new share in at least a decade. In fact, they bought some back during that period of time. Free cash flow is trending up over the last few years, which I like. If we go back over to the insights here, the dividend is lower, but the dividend is still just under 10%, so I wouldn't be concerned about that. Analysts are very bullish on this company, like I mentioned. Earnings are projected to go up a lot over the next year or two, which is something that you want to see in any company. Again, the growth is also very nice. Financial health is like I say, very nice. It is a very strong balance sheet. Not the best you'll ever see, but very strong. Probably in the top 10% in my opinion. Profitability, again, very good as well. Returns also very good. Valuation, the PE is a little bit lower than the 5-year average, but the price to free cash flow is actually 15% below, which is exactly where you want to see. PEG ratio is looking really good. So again, in my opinion, this is if you're looking at something other than a pure oil and gas play in the energy sector, this is a company that I think is worth a look. especially if you're looking for a company that pays a dividend and a very strong dividend, right? I mean, you're looking at a company that's paying a 10% dividend that has a free cash flow payout ratio of 62%, right? So cash flow would need to go down pretty significantly for this company to cut its dividend, right? And that's something that is very good. Like I said, I don't think you're going to necessarily get rich off this stock. I don't see you 10xing your money. It's technically possible, but I think that this is a company that, yeah, you're going to get over the next 10 years. I think you'll get when you include the dividend, I don't know, 15% return a year, 10% probably being on the low end, 10 to 15%, and that's going to beat the market, right? And not only that, you're getting a dividend that you can use to reinvest wherever you see fit, right? And I always like dividend paying companies. Usually I prefer dividend growth companies. Energy companies are typically not going to be dividend growth, but if they're already paying a strong dividend, then it's not the end of the world if they're not growing that, right? And again, you're looking at an industry that has tailwinds, in my opinion. If we get a recession, it's highly likely, but energy companies, commodity companies, those prices are going to come down because we're going to get reduced demand, which means, in my opinion, I think that if you don't have a position, that would be the time to start it. I think a lot of these companies you can start dollar cost averaging into right now. Company like this, Devon, my favorite oil and gas company, I think is priced fairly attractively right now. If you can get it below 65, I think it's a good deal. This company I think is a solid deal. Again, I don't think you're going to get rich off a oil and gas company like you could a tech company or something along those lines, but if you're looking for a company that has, or a company or an industry that has tailwinds, is there anything better than commodity companies, right? And a lot of people would disagree with that, right? A lot of people, I don't like them because they're inconsistent or this or that. But it's like, when you're looking to invest, you're looking to invest in areas that have tailwinds, right? And not only that, in a higher rate environment, again, I've said this a million times, but there's a lot of people that still don't know this. You're looking for companies that produce in the here and now, right? The problem with, and the reason why a lot of these tech companies have got hit so hard is because their growth, their earnings is projected a lot of times, 10, 20 years in the future. But in a higher yield environment, growth in the future is going to be discounted more and more and more, because the more you can get from a bond, the less attractive it is to buy a company where the growth is projected way out in the future. One of the benefits of companies like these energy sector companies is that they're experiencing a lot right now and in the very near future, right? I mean, I talked a lot about Tesla before, right? The bull case for Tesla is, AI, self-driving, all this kind of stuff. But that stuff's not happening anytime soon. Again, they're coming out with it, but it's not going mainstream for probably not till the 2030s, maybe even longer than that, right? So that's another thing that people, I think, need to keep in mind is the best companies are going to be in the near future and over the next decade, I think, are going to be companies that their growth and earnings are happening right now, right? The things that we really need right now and the things that we're really going to need in the very near future. Artificial intelligence and a lot of this fancy tech, we don't need right now. We probably need it a decade or two from now, but we don't need it right now. We need energy right now, especially when prices are going way up. That's also going to make it more attractive for the cheapest forms of energy, which is oil, gas, coal, that kind of stuff, right? Again, believe it or not, the last year we had the most worldwide coal usage in the world, right? So people that think that, oh yeah, we're phasing out oil and gas tomorrow, it's not happening. It probably happens at some point, but it's not happening as soon as people think. And because it's not happening as soon as people think, companies like this are going to benefit, right? And in my opinion, the best way to invest is not the get-rich-quick mentality. That it worked in a lot of ways over the last decade or so, especially coming out of 2020. But I don't think it's going to work as good, and it clearly hasn't worked as good over the last year, and I think that that's going to be a sign of things to come. Although I do think that tech and some of these sectors, they will grow. They're just not going to grow at the rate that they did over the last decade or so. So anyway, that's what I wanted to bring up today. If you like the video, hit that like and subscribe, and stay tuned for more.